Canada posted a merchandise trade surplus of $1.78 billion in March. Analysts had forecast a deficit of $2.88 billion. That is a $4.66 billion swing from consensus, in the wrong direction. The last time Canada ran a surplus was October 2025, 6 months ago. The S&P/TSX Composite climbed more than 1.3% on Wednesday, touching 34,005 points, as miners surged on growing hopes of a U.S.-Iran ceasefire. North American equities broadly pushed higher, with the S&P 500 and NASDAQ 100 each setting new all-time records, powered by blowout AI earnings from semiconductor companies and a sharp oil price slide tied to diplomatic signals out of Tehran. On the surface, it was a day defined by technology and geopolitics. The trade data that landed Tuesday told a different story about where Canada actually stood. Total Canadian exports rose 8.5% in March to $72.8 billion. Metal and non-metallic mineral products, think gold, copper, uranium, jumped 24% to a record high. Energy exports climbed 15.6% to their highest levels since September 2022. The Bank of Canada governor, in Senate testimony this week, confirmed inflation projections would remain largely stable into July. The macro backdrop looked orderly. What was less orderly was the mechanism that produced those numbers. The Iran war changed Canada's export math in ways that almost no model predicted. Crude oil prices surged on the Hormuz blockade. Canada's oil sands producers, including Suncor, TSX-SU, which reported Q1 net earnings of $2.1 billion, up from $1.69 billion a year earlier, and Cenovus, TSX-CVE, which held its annual shareholder meeting Wednesday, were lifting volumes into a market starved for non-Hormuz supply. Meanwhile, gold demand globally accelerated even as gold prices softened. Buyers were purchasing volume, not chasing price. Canadian gold exporters shipped more metal at slightly lower per-unit values, and the aggregate still hit record territory. The surplus arrived precisely as Honda, TSX 7267, was definitively shelving its $15 billion electric vehicle complex in Ontario, a project Prime Minister Carney acknowledged faces significant challenges from U.S. tariffs. Canada's new economy ambitions stalled. The old economy quietly printed a $4.66 billion beat.
The connection between a blocked strait in the Persian Gulf and a Canadian trade surplus runs through 3 links, and each one matters to a different TSX sector. The Hormuz crisis, now in its 9th week of closure, rerouted global crude flows. Countries that previously sourced Middle Eastern oil shifted demand toward non-Hormuz producers. Canadian heavy crude, Western Canada Select, held its discount to WTI steady, but benefited from the WTI price surge itself. Canadian oil exports by value rose, even if volume growth was modest. That is the first link. Price, not volume, drove the energy export gain. The second link is gold. Global buyers accumulated gold as a safe haven asset through the conflict. Gold prices themselves retreated in recent sessions. The price rebounded Wednesday on U.S.-Iran deal hopes, then slid again as the deal stalled. But March's gold export data captured a period when buyers prioritized physical accumulation over price negotiation. Canadian gold producers, including B2 Gold, TSX BTO, which reported Q1 results, and Equinox Gold, TSX EQX, which posted strong Q1 financials and is scaling its Canadian platform, contributed to a metal export category that reached a new all-time record. The third link is structural, and it cuts the other direction. Excluding energy and metals, Canada's exports rose only 1.1% in value terms and actually fell 0.3% in volume terms. Strip out the war premium on oil and the safe haven premium on gold, and Canada's underlying export trajectory was essentially flat. The surplus is entirely a function of 2 commodities responding to one geopolitical event. That is where the condition breaks. A U.S.-Iran ceasefire, the very news that sent the TSX higher Wednesday, would compress WTI prices, narrow the energy export value gain, and reduce the urgency of physical gold accumulation. The $1.78 billion surplus in March could revert toward deficit territory in April and May data, precisely because diplomatic progress was being celebrated in markets on the same day the surplus numbers were published. Suncor shares fell Wednesday despite stronger Q1 earnings, pointing to exactly this tension. The operational results were strong, but forward-looking energy prices were declining on peace optimism.
The March trade surplus is the clearest evidence yet that Canada's resource base functions as a geopolitical hedge. When global supply chains fracture, Canadian energy and metals outperform. That is not a new thesis, but the $4.66 billion forecast miss gives it a concrete number to test against.
In the 2022 Ukraine war period, a structurally similar dynamic played out. Canadian energy exports surged as European buyers scrambled for non-Russian supply. The TSX energy sector outperformed North American equity peers, and the trade balance swung sharply positive. That episode lasted approximately 3 quarters before LNG rerouting and demand destruction normalized the premium. The current Hormuz-driven cycle is earlier in its progression, 9 weeks in versus the multi-quarter Ukraine arc, which means the commodity premium may have more runway or may compress faster if diplomacy succeeds. 2 conditions determine continuation. First, if the Hormuz Strait remains closed or only partially reopened, Canadian energy export values hold elevated into April and May data. Watch the weekly EIA crude inventory numbers. U.S. crude inventories continued falling in the latest report, a signal that supply displacement is ongoing. Second, if gold demand for physical accumulation persists above the $3,000 per ounce psychological floor even as the war premium fades, Canadian gold producers maintain their export volume momentum. Cameco, TSX CCO, saw its price target raised to C180 at National Bank Financial this week, pointing to sustained institutional interest in Canadian resource names beyond just gold. Breakdown conditions run directly through the ceasefire calendar. A formally signed U.S.-Iran agreement reopens Hormuz, collapses the oil supply fear premium, and removes the primary driver of Canada's energy export value spike. The TSX miners, which led Wednesday's advance on ceasefire optimism, would face a counterintuitive outcome. Peace that the market celebrated on day 1 may arrive as an earnings headwind by Q2 reporting season. The verification benchmark is straightforward. Watch Canada's April trade data due in June against the $1.78 billion March baseline. If the surplus holds or widens despite oil trace normalization, it signals that volume growth has taken over from price as the driver, which would be a more durable signal. The leaning here favors a surplus that narrows but does not immediately reverse, because gold demand and energy volume commitments carry multi-week delivery legs beyond the spot price. Honda's withdrawal from Ontario suggests that manufactured goods exports will not offset any commodity softening. The new economy backstop that Canada was counting on is no longer in the equation. If the ceasefire holds and oil drops toward 65 WTI, the question becomes whether Canadian miners can carry the trade balance alone. That has never happened in a sustained way without a concurrent gold price rally. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.